So let's talk about something that feels like financial bedrock, a goal that's basically drilled into us, paying for your home all cash. It sounds like the absolute dream, right? But what if I told you that this piece of conventional wisdom might actually be a massive financial mistake? Today, we're going to make the case for why using the bank's money could be one of the smartest things you ever do. And look, I get it. We should start by just admitting how appealing that all-cash dream is. The thought of owning your home completely free and clear with no mortgage payment hanging over your head every month, that is a powerful, powerful idea. It's the picture of security. For years, this has been held up as the absolute pinnacle of financial security. It's the sign that you've made it. You're safe from the banks. You're free. It's a goal people will literally spend their entire working lives trying to reach. But hold on. What if that entire way of thinking is just completely backward? What if, by tying up every last dollar in the walls of your house, you aren't actually securing your future, but you're costing yourself a potential fortune? Yeah, that's the pretty radical idea we're diving into right now. So, how could this possibly be a mistake? Well, the whole argument really boils down to one simple, but absolutely crucial economic idea that we tend to forget about when we're making these huge life decisions. It's called opportunity cost. Let me put it this way. Every single dollar you put into one thing is a dollar you can't put somewhere else. It's gone. So when you sink your life savings into a house, the real cost isn't just the $500,000 price tag. It's all the growth you could have had if you'd invested that money somewhere else. That's the hidden price. And this is where you can really see the two paths diverge. The all-cash buyer, 100% of their capital is stuck in one single asset, their home. It's not easy to get to. But the leverage buyer, well, they only put down a fraction, maybe 20%, and that frees up the other 80% to be out there working for them, growing in the stock market, you name it. And that leads us to one of the most powerful and honestly most misunderstood tools in all of finance, the mortgage. We're taught to see it as this scary debt monster. But what if we reframed it? What if we saw it as a powerful tool called leverage? Now look, you got to be careful with it for sure, but when you use it strategically, wow, it can be a game changer. So what does that even mean, leverage? It's actually simple. It's just using a little bit of your own money to control a much, much bigger asset. The bank lends you their money at a pretty low rate, and you use it to buy a house that could potentially appreciate at a much higher rate. Now, the key word there is potential. Leverage is a double-edged sword. It can absolutely magnify your losses just as fast as your gains if things go south. So how does this actually work to build wealth? It's pretty simple, really. First, you put down that small down payment, say 20%. Step 2, you now control 100% of the house. And here's the kicker, step 3, if that house goes up in value by 5%, you get the entire gain on the home's total value, not just on your little slice. Your return gets supercharged. Okay, so theory is one thing. Let's really put this to the test and see how it plays out in the real world. We're going to compare the financial journeys of two different homebuyers and see just how wildly different their results can be over time. All right, let's say we have a $500,000 home. Buyer A goes all in, pays cash. Their entire $500,000 is now tied up in that house. Then you have buyer B. They put down a smart 20%. That's $100,000, and they take the other $400,000 and put it into a diversified investment portfolio. Okay, now for the magic. Fast forward 15 years. Now, this assumes historical averages for real estate in the stock market and, of course, no guarantees, right? But look at this. Buyer B, the one who took out a mortgage, ends up with a substantially higher net worth. It's not even close. And why? Because that $400,000 they invested has been compounding and growing all that time, while buyer A's money has only grown at the much slower rate of home appreciation. So all of this kind of forces you to rethink the goal, doesn't it? Maybe being debt-free at all costs isn't the smartest move. Maybe the real goal should be using good debt strategically to build our wealth as efficiently as possible. So really, when you boil it all down, this strategy gives you 3 huge advantages. First up, liquidity. You have cash ready for anything, an emergency, a great new investment. Then there's diversification. Your entire net worth isn't riding on the value of one single property in one single neighborhood. And finally, the big one, amplified returns. You're letting your money work hard for you in multiple places at once. So we'll leave you with this question to chew on. Listen, that feeling of owning your home free and clear, that's real. That peace of mind is powerful, and you can't deny it. But the math often points down a different path, a path to potentially much greater financial freedom. So the question really becomes, what's right for you? Is your ultimate goal just to own your house? Or is it to have your house be a tool that helps you own your entire future?